Hey, hi, this is Gautam. Welcome back. So this is video 2 of my secured lending industry analysis series. This is going to be the second and final video of this series. So in video 1, we understood this secured lending to the retail segment theme. We understood what is secured lending. We looked at the retail segment. We understood as to why this is an attractive industry. Why is this an attractive space to be in? We decoded the current market size of this industry. We also took a stab at estimating what could be the potential future market size of this industry. Okay, so this was video 1. Now in this video, which is video 2, we'll understand as to how do you analyze NBFCs. Okay, and so specifically we look at 3 NBFCs operating in this space, which is FedFina, SBFC Finance, 5-Star, and as I said, we'll understand as to how do you analyze NBFCs in the first place. Okay, so we'll understand the ROA tree. We'll look at what drives ROE. Okay, what drives ROE, okay? And then we'll also understand the asset and liability profile of NBFCs. All right. So hope you find this content helpful. All right. Thank you. All right. So see, for any financial institution, it's important that you look at their liability profile and their asset profile. By liability profile, I mean the sources of funds. Okay, what are their sources of funds, and at what interest rate are they able to raise funds? See, banks, okay, they raise money in the form of deposits. They can raise money in the form of deposits, right? Because we as customers, we park our money with banks and they give us a small interest rate, right? So banks can raise interest through deposits. Okay, and NBFCs are not allowed to uh, keep deposits. So NBFCs, their source of funds are in turn are banks itself, or they may raise funds from mutual funds, etc., etc. And of course, the rate at which NBFCs raise funds is higher than the rate at which banks they raise funds. Okay, all right. So let me. I've like prepared some notes ahead of time. So let me just take you through my notes. All right. So now I've flipped over to my notes. Yeah. So let me first take you through the liability profile of these NBFCs. By liability, I mean the source of funds. Okay. See, banks के लिए source of funds are deposits are a very key source of funds for banks. NBFCs, okay, non-deposit taking NBFCs, okay, they raise their funds from banks or from mutual fund houses, etc., etc. Okay. All right. So, so if you talk about FedFina is a corporate backed NBFC. इसका मतलब ये हुआ FedFina, it's a subsidiary of Federal Bank. Okay? And having a good parent, a strong parent like Federal Bank ensures that you have good access to funds. Okay? And then, during the NBFC crisis back in 2018-19, FedFina had no problems whatsoever in raising funds when most of the NBFCs were struggling. So that's the benefit of having a strong parent. On the other hand, SBFC and 5-Star, they are independent. They are not subsidiaries of any bank. They don't have that kind of backing as FedFina has. So that's a very strong differentiator for FedFina. Now, if you talk about the rating, all these NBFCs have a credit rating, okay? And of course, a credit rating determines at what rate you can raise funds. Okay? So FedFina has a higher credit rating than 5-Star and SBFC. So as a result, FedFina is able to raise funds at a slightly lower rate. And the reason why FedFina has a higher credit rating is because of the strong parent. So it kind of works, works for you. Okay, that's why you are able to raise funds at a slightly lower rate. Okay, so this is on the liability profile. Okay, I'm just kind of giving you a quick walkthrough. Okay, and if I recall, FedFina raises funds at just under 9%, and 5-Star and SBFC is able to raise funds at 9% or slightly over 9%. Okay, and having good access to capital and being able to raise capital at a lower cost is very crucial in this business. Okay, now if I move forward, if I talk about the asset profile, let me just flash my table here. Okay, so if you look at this table, FedFina has 85% of its book secured. Okay? 5-Star on the other hand has 100% of its book is secured. Okay? And अगर हम लैप लोन्स की बात करें तो 50% of FedFina का book is loan against property, and 5-Star का 100% of their book is loan against property. Okay? And of course, the ticket size of these lap loans are different for all these 3 NBFCs. FedFina ka it's a very huge range. They kind of give out loans between 5 lakh to 1 CR. In fact, at times even over 1 CR. SBFC is between 5 and 30 lakh, which is the highest, fastest growing segment. I think this is also SBFC. This 5 to 30 lakh is a I would not call it the fastest, but it's a very it's a high growth segment. And 5-Star less than 10 lakh. So their ticket size is less than 10 lakh. So they are in this very small ticket sizing, loan ticket sizing. Okay, and here I have the market size, current market size of all these ticket sizes listed. Okay, and I also have the potential future market size of these ticket size loans. Okay, so you see, of course, since FedFina is kind of offers both small and medium ticket size loans. Okay, so uska market is bigger vis-a-vis SBFC and 5-star. Okay, यहाँ पे I have a note कि FedFina, it offers two products: small ticket size loans of average 14 lakh and medium ticket size loans of average 62 lakh. Okay, so see the benefit of providing loans of different ticket sizes is that when one ticket size, because of course those loans are for different customer profiles, right? Okay? So when one ticket size is not doing well, then you can kind of be on the back foot on that particular ticket size and focus more on the other ticket size, which is what is happening right now in quarter 2 of FY25. The small ticket size loan segment, okay, there was some stress building up on the small ticket size loans, so they focus more on the medium ticket sizing wale loan. Okay? So that's why it kind of gives you the flexibility if you have a wider product portfolio. But at the same time, if you are like एक ही चीज पे फोकस कर रहे हो, तो you of course become very good at that particular. अगर आप बहुत ज्यादा फोकस्ड हो, तो that is not necessarily a bad thing, because of course you become very good at it over time. Okay, so any which ways, दूसरी चीज, see, FedFina and SBFC, they are not just in LAP loans, they're also in gold loans. In fact, FedFina ka more than one third of the book is in gold loans, and 5-star does not have any gold loans. Okay, so and what's the benefit of giving out gold loans? मतलब you customers, they put gold as collateral, gold गिरवी रख के लोन लेते हैं. See, gold loans are counter cyclical. Okay? When the economy, the macro environment is not conducive, gold as an asset does very well. जब कुछ काम नहीं करता तो gold काम करता है. तो gold loans are counter cyclical. Okay, so gold is a safe haven in that sense. Okay, and so gold of course is a very good collateral, appreciating collateral. Okay, so and of course gold loans are of smaller ticket sizes. Okay, all right. So one thing more. Okay? One more observation here. Okay? Is there's a rule called SBFC, which is I'm just forgetting the name. Let me just pull up the name. Yeah. So this act is securitization and reconstruction of financial assets and enforcement of security interest. Okay. By this law, banks and other financial institutions are allowed to auction residential or commercial properties of defaulters to recover loans. Okay. All right. तो इसका मतलब ये हुआ कि what it means is, and this particular law can only be enforced when you are giving loans of higher ticket sizes. If you are giving loans of smaller ticket sizes, then this law doesn't work. Then you cannot enforce this law. Okay. So, and because 5-star and to an extent SBFC, they are present in smaller ticket loan sizes, so they can't use this SBFC wala law for stressed loan recovery. Okay. So these two, 5-star in particular, it has low collateral enforceability. Okay, even though 100% of its book is backed by collateral, but it has low collateral enforceability because of this reason. Okay, so this is something that we need to keep in mind. Okay, moving forward, I'm not kind of giving you any recommendation or what have you. I'm just trying to walk you through, let's say, the framework as to how you should analyze and what parameters you should think about when you analyze these businesses. Now, of course, this is a very interesting theme, as I have been saying all along. Okay, now one thing more. Let's go further. Let's dig further on the asset profile. Okay, so let me flip to a different screen. See, this is an education channel. Okay? So first, now I want to kind of spend the next 4-5 minutes on trying to make you understand as to which financial metrics you should be looking at, okay, in analyzing these kind of businesses, these kind of financial services businesses. All right. So first, the most crucial metric, of course, is ROE, which is profit after tax divided by equity. What it means is that for every rupee of equity, how much profit are you generating? That's ROE. Okay. And why is ROE important? First, I have the ROEs, FY24 ROEs listed of all these 3 NBFCs listed here. 5-star Finance seems to have the highest ROE. Okay, and FY25 Q2 mein, the ROEs have changed a little bit. Okay, but this is just to kind of make you understand. First point is, why is ROE important? See, long-term stock price compounding for financial institutions, they follow book value per share compounding, which in turn depends upon the institution ability to deliver high ROEs over the long term. Okay, so that's why uh, high ROE, if a firm is able to kind of deliver high ROE for a prolonged period, for extended periods of time, okay, then that business generates a lot of shareholder value. Okay? So of course, maintaining high ROEs is very important in this business. Okay, but so let's double click on ROEs. Okay, as to what parameters they kind of make up ROE. So if we kind of just rearrange the ROE terms, if we multiply and divide by assets, okay, so the ROE equation can be rewritten as net profit by assets times asset by equity. Okay, इसका मतलब क्या हुआ? ROE could be thought, the ROE could be broken up into two components. This is essentially the DuPont formula. Okay, this is ROE could be broken up into two components. One is ROA times leverage. ROA return on assets times leverage. दोनों को समझते हैं. ROA क्या है? Leverage क्या है? And how do you first let's try to understand what is ROA and leverage, and also let's try to interpret the significance of both these two terms, okay, and how you should be looking at these two terms, these two financial metrics. Okay. Okay. So here I've broken up the ROEs of these three NBFCs into ROA and leverage. You see FedFina has the lowest ROA and the highest leverage. Okay. 5-star on Finance, on the other hand, has the highest ROA and lowest leverage. समझते हैं what it means. Okay. Let's first talk about ROA. See, an ROA of 2%, it means that the financial institution, NBFC in this case, makes ₹2 on loan of ₹100. So अगर 2% का ROA है, it means that it makes ₹2 on a loan asset of ₹100. So higher the ROA, it's always better. Higher the ROA, the better it is. Okay, and I'll spend more time on ROA in the next slide. Okay? So first, let me talk about leverage. Leverage is asset by equity, asset divided by equity. That is what leverage is. ₹1 के equity में how much worth of assets you have on your books. That is leverage. Okay. So there are two interpretations of leverage. First, let me take you through first interpretation. Okay. And leverage के case में, the lower the leverage, it is better. ROA के case में, the higher the ROA, it is better. Leverage के case में, the lower the leverage, it is better. So let's try to understand why. Okay. See, FedFina का leverage is 5.6. If we do a reciprocal, instead of asset by equity, if in our mind, if we do equity by asset, इसका मतलब क्या हुआ? 1/5.6 का मतलब क्या हुआ कि FedFina has an equity of ₹18 on asset of ₹100. Okay. Similarly, as SBFC Finance has an equity of ₹36 on asset of ₹100, and 5-star has an equity of ₹44 on asset of ₹100. Okay. And of course, now having a higher equity is better. Why? Having a higher equity is better, lower leverage is better, and that is higher equity proportion is better, because see, the reason is just let me take you through this. I've written a blog on this as well. See, lower the leverage is better because when you have lowered balance sheets, a small change in asset quality, it wipes out a big portion of your equity, which leads to credit agencies, downgrading, and then of course the company goes on a downward spiral. Okay, so that's why you would want a lower leverage, okay, and you would want higher equity. You would want the financial institution to be very well capitalized, and you would want it to have a lower leverage ideally. Okay. And the second interpretation, this was one way how you should look at leverage. Okay? And the second interpretation for leverage is, is if you look at this equation here, leverage is assets by equity. Asset by equity in turn can be broken up into 1 plus debt by equity. 1 plus debt by equity. इसका मतलब क्या हुआ? FedFina has a debt by equity of 4.6. SBFC Finance has a debt by equity of 1.8. 5-star Finance has a debt by equity of 1.3. इसका मतलब FedFina, अगर हम 4.6 है उसका debt by equity, इसका मतलब on equity of ₹1, FedFina has taken a debt of 4.6 times that of equity. अगर ₹1 का equity है, then it has taken a leverage debt of 4.6. SBFC Finance, on ₹1 of equity, it has taken a leverage of 1.8. 5-star, on equity of ₹1, it has taken a debt of 1.3. Okay. So इसका so what it means is कि SBFC and 5-star Finance, okay, they can grow by leveraging. मतलब they can take more udhari, they can take on more debt in the future till the leverage reaches a certain level. See, please try to understand. You can only lever up to a certain degree. Okay, you can take leverage udhari, okay, only to a certain degree. Okay, मतलब let's say if your leverage is 7-8 times, Okay, if your leverage ratio set by equity 7-8 times, uske beyond you can't take leverage, you can't lever. Okay, because what it would mean is that you will have very less equity on your books. It would mean you're not well capitalized. If you have very low equity on your books, it means you are very low, you're not well capitalized. Okay, and of course by RBI regulations you have to be capitalized adequately. Okay, all right. तो अगर आपके पास अभी leverage is low, मतलब आपने उधारी कम ले रखी है, आपके पास equity बहुत ज्यादा, if you have more equity, you have less debt, which is the case with SBFC and Five Star Finance. So what it means is both these two NBFCs can, at least for the foreseeable future, they can grow by leveraging, by taking on debt till the leverage reaches a certain level. Okay? But FedFina, on the other hand, since it already has a decent leverage or higher leverage level, okay, it will likely have to raise equity to fund its future growth. Okay, all right. Okay, so all right. So hope this is clear. Okay. Now let's move forward. All right. So now let's talk about, let's double click into the ROAs, okay, the return on assets. Okay. So what I have here is you could call them ROA trees or ROE trees. Okay. So I have the ROAs of all these three NBFCs listed here. Okay. So if you see, let me just select a pen real quick. Okay. If you see the ROA of FedFina is on the lower side, but for FedFina, for Five Star Finance, it's 8.4. So there's a huge variance in ROAs. And SBFC Finance is somewhere in the middle. It's closer to FedFina. So there's a huge variance in ROAs. Okay. So let's try to understand that. Okay. So first, to understand, let me pull up the ROA trees that they have presented in the investor presentation. So let me go to the next slide. So I have the snapshots of the ROA trees for both these companies. On the left, I have FedBank, FedFina. On the right, I have Five Star Finance. Okay. So if you look at year FY24, the net the interest income, okay, the yield, the interest income or the yield that FedFina, okay, charges its customers is closer to 14%. Whereas if you look at the right, okay, the interest rate or the yield which Five Star Finance is able to charge its customers is as high as 24%. And the difference between the yields or the interest income is because of the kind of customers they serve. Okay, because of course they serve different customers. They give out different ticket loans or different ticket sizes. So that's why there's a huge difference in yields. Okay, and I also wanted to kind of show you a snippet of the RFP, or sorry, the RHP for FedBank or FedFina. Okay, so let me just move over there real quick. I've just flipped over to the RHP for FedFina. So if you look at you can pause this video and just observe this table. Okay, so if you look at the first two line items. Okay, so if you have a small ticket size, if you are giving out loans of small ticket size like Five Star Finance, okay, then the yields that you can make on those loans is high. Okay. The drawback is that of course the collateral enforceability on those loans is low, although all of your loans are secured, but the collateral enforceability is low given the SARFAESI law which we just discussed. Okay. But if you are present in small to medium ticket sizes like FedFina, okay, then the yields are medium, 14%, like we just saw. Yields are like 14%, but the collateral enforceability is on the higher side. I just wanted to kind of show you this snippet. Okay. Now let me move back to my notes where I have the slide snapshots of the investor presentation. Let me move over there. Right now, okay, if you come down, if you look at FedBank, okay, 14% though is the yield that they make. Okay? From that 14%, of course, you have to give out interest, okay, to the bank from which you raised money. Okay, so you give out interest, okay, and of course you add any fee income that you make. So net, what you're left with is 9.3%. Okay, which is also called the net interest margin or the net total income. For Five Star, the same number is around 17.4%, 17%. Okay, that's the net interest margin. Net interest margin ka matlab, okay, it's the differential between the interest rate that you charge on the loans that you give out and the interest rate that you need to pay to the bank, okay, from which you raise the money. Okay, so that's the net interest margin. So ye in dono ka, that's why of course because there's a difference in yield, so that's why there's a stark difference between the net total income or the net interest margin of both these two NBFCs, and SBFC Finance is somewhere in the middle. It's closer to FedBank. Okay. Now with that understanding, let me go back to the last slide. यहाँ पे if you see, as you saw in the last slide, this is the entire breakup of ROA. This 2.4, okay, is of course a function of this net total income, and this 8.4 is a function of the 17.4. Okay, so the huge difference in total net income explains the variability or the difference between these ROAs. Okay, and of course, from that net total income or the net interest margin, you need to net out OPEX, you need to net out provisions, you need to net out tax. Okay, so if you look at OPEX or the operating expense that you incur, okay, so it's kind of all these three are in the close ballpark. Okay, all right. SBFC Finance seems to be doing a good job at keeping its expense under control. Okay, right. And so if FedFina is able to, let's say, lower its operating expense, and that will flow incrementally to ROA. So it will be able to generate a higher ROA. Okay. All right. And one thing more which I wanted to add, five-star finance, not all the loans given out by five-star finance are productive loans. Okay, what I mean by that is, what I mean is the business purpose, the purpose of those loans. Okay, 60%, if I recall the number correctly, 60% of the loans given by five-star finance are the purpose of those loans is to grow business for working capital needs, etc., etc. Remaining 40% is for non-productive purposes, or for if people for marriage or etc., what have you. Okay, but most of the loans given by FedFina and SBFC Finance are for productive uses, to grow business for working capital needs, etc., etc. All right. So, any which ways, the broader takeaway is five-star finance has the highest yield, and hence it has the highest ROA owing to its presence in loans of lower ticket sizes. Okay. And so this ROA variability, okay, has of course made its way into ROE. Okay, because ROA times leverage is ROE. Okay, and because there's a difference in ROE, and five-star finance has done a good job at maintaining like 17-18% ROEs over the last few quarters, last few years. Okay, so which has reflected in its valuation as well. So if you look at the valuation, okay, I'm just talking about relative valuation. Let me just go to screener real quick. Okay, I'll just quickly move to screener. So यहाँ पे what I want to check is the price to book multiple. अरे कहाँ गया? So if you look at the price to book multiple, okay, for FedFina, sorry, for five-star finance is 3.3. Okay, okay, यहाँ पे 3.3. For FedFina, the price to book multiple is 1.5. Okay, and then for SBFC Finance, it's closer to 3, I think. Yeah, it's closer to 3. Okay, for SBFC Finance, closer to 3. Okay, so because five-star finance has generated such high ROAs, so that is reflecting in its richer valuation. Okay. So I'm not getting into DCF valuation. A lot of people do not like to use DCF valuation for financial services, which is fine, to each their own. Okay. So any which ways, I would not like cover DCF valuation in this video. I just wanted to kind of show you, okay, how the valuation is stacking up relatively across these three companies. If we just look at the price to book multiple. Okay. Now let me go back to my notes. All right. So I'm back to my notes. Let me just move down. Okay. Another point that I want to discuss was on the distribution. You see, SBFC and FedFina. Okay? SBFC is present in like 16 states now in India, which are responsible for majority of the credit in India. Okay? And in fact, FedFina is also present in around 17 or 18 states now. Okay? And both of these two companies, FedFina and SBFC, they are trying to further deepen their penetration in the existing states, existing areas that they are in. Okay? Five-star now is predominantly present in South, in Andhra Pradesh, in Telangana, Tamil Nadu, and it's trying to gradually move up north as well. Okay? And it has done very well in terms of growing its AUM until now. And of course, as you saw, it has the highest ROAs. Okay. Yeah. All right. Now, if I talk about the barriers to entry in this business, yeah. So at first, it would seem that this business technically has no barriers to entry, yeah, but it actually has if you think about it, because see, operationally, it has very high barriers to entries, I would say, not technically. Okay, because operationally, because see, borrower income assessment and assessing the repayment capability, the credit worthiness of the borrower, okay, is of essence in this business. Okay, because of course the borrowers, the prospective borrowers, they do not have proper documents. They do not have a good credit history. So trying to gauge their credit worthiness, okay, and the repayment capability is a very extensive process. Okay, which these NBFCs seem to have cracked. Okay, all right. And of course, banks के लिए, as we have discussed, it becomes cost prohibitive for large financial institutions to kind of operate in this secured MSME lending wala space. Okay, all right. So, this is a very interesting theme in that sense. And of course, every good thing comes with risks. There's still that lurking great quality of customers. Okay? NPAC, all these three NBFCs have done a good job at NPAs. Their NPAs are under control. But again, one of the key risks which is yet to be seen is the books of these NBFCs are relatively have lower seasoning. इसका मतलब क्या है कि पूरा एक asset cycle complete नहीं हुआ है. किसी ने, if someone has taken a loan, okay, the loan tenure, let's say, is 5 years, 7 years. That tenure needs to kind of be completed. Okay, for the first 2-3 years, everyone kind of pays off their interest and a portion of the principal, but it needs to be seen whether they'll kind of uh, 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 be there for the entire tenure of the loan, whether they'll be a good customer for the entire tenure of the loan. So seasoning abhi proper 100% nahi hui hai. Okay, so that's a risk that there's that risk in this business. Okay, all right. So all right. So this concludes my analysis of this theme, secured lending to the retail segment theme. As I've presented my reasoning as to why I find this theme particularly attractive, and it's particularly attractive in times like these. Okay, uh, in cautious times like these. Okay? And this is not a buy or sell recommendation. I'm not trying to say that you invest in this company or you disregard the other one. I'm not saying that. I just wanted to kind of walk you through the parameters that you would analyze in in trying to screen the companies in this theme. Okay, right. So hopefully this was helpful. Okay, write to me if you have any questions. Okay, and yeah, and also if you want to get my free education letters, then let me know and I'll have you added in my distribution list. All right, thank you. Well, hope you're finding my content helpful. Please write to me if you have any questions. Also, write to me if you want to join my equity research and valuation cohort program. Because in this program, I have analyzed in detail, I've analyzed and valued three companies from different industries. Okay. So, this is a practical and hands on program. I've strived to keep theory to a bare minimum and covered concepts through live exercises. So, if you're serious about learning equity research and valuation, then you would certainly find this program very helpful. All right. So, please write to me. Thank you.